Hello again, this is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is June 1st, 2020, and there are three topics we're going to discuss that are moving the markets. Markets finished up positive, all three indices today for the first trading day of June. So there's a lot to digest, so let's get right to it. So our markets started off relatively strong for the first trading day of June. All three major indices ended positively today. And markets turned around midday on one number. It was the ISM manufacturing number. And that number really is an indication that, if it's a number that we watch, especially in the industry. If it's 50 or higher, that means your economy is expanding. Well, we're not in that mode, but we were well below 50. That was one of the indicators that, the economy is contracting. But the good news is that as soon as we heard the May print, which is 43.1, it was up from the April 41.5. That's a positive. So less bad news is good news, if you will, as it relates to the economy, just showing that there are manufacturing orders coming in. Later this week, so that was today, the manufacturing ISM number. Later this week, we have services ISM data. But Thursday and Friday, to round out the week, is going to be extremely important. We're going to keep looking that the trends are getting better for initial jobless claims and in unemployment. Now let's talk about that. Unemployment or initial claims, this is an inversely related, correlated phenomenon that we're seeing. I wanted to share this chart with you. The blue line is the S&P 500, and the red line is basically an inverted, just for the parallels to show you, an inversion overlay of the S&P 500. It's the initial claims. And so as we see the initial claims basically decreasing, we're also seeing improvements in the market, so S&P 500 specifically. So this trend has been, it's positively correlated, and it's something that the market cares about the most, really, that the employment number is going to be a huge issue. And that, it's one thing to have high unemployment. It's another thing to see that the initial claims start, becoming less and less over time. That just means people are going back to work. So that's a key factor as it relates to, the data that's going to come out later this week. And we're going to pay attention to it because it could move markets. So in my morning research, there was a positive sort of constructive long-term trend playing out that we're seeing underlying in the S&P 500 very specifically. And what that is the setup is this. It's 96% of the stocks are above their 50-day moving average, which is a very strong positive signal. And in the last 20 years, just anecdotally, when that has happened, the few years going forward have always been positive. So it sets up a multi-year positive trend. In fact, in those cases, and under that sort of analysis, it's been 100% of those times on a go-forward basis that long-term trend persisted. So, we don't know how this will play out on a go-forward basis. We can't clearly predict or even forecast that. But when you see something to this magnitude, strength within building underneath in the S&P 500, that long-term positive trend is something to take note of. So we're going to continue to watch and monitor that. But I think it was interesting to report what's happening behind the scenes, as I talked about the S&P in a range before and now consolidating, and now we're seeing rotation within. There's a lot of, and then this information that I just reported on, there's a lot of positives to take note. So let's continue to monitor the S&P and see where we go from here. One of the topics I want to discuss is we're seeing positive sort of yields moderate, or the spreads, the tension, if you will, in the high yield market, really easing. So it's a day-over-day deal since the last few months, and it's extremely important. That's another thing the S&P 500 is watching, because we want to see that positive sort of ease of tension, added liquidity in the high yield market. Now, that's not to say that we're not going to see a lot of pain on a go-forward basis in the high yield market. In fact, we're going to see a lot of that. But in the short term, to get us through sort of this period of time, I think that's a positive setup. It's something to take note of. So the credit markets are sort of healing in the short term, but we constantly keep monitoring them because it has to support the credit market. Sort of will dictate what we will see out of the implied volatility going forward in the VIX, as well as keep an eye on the 10-year Treasury. That's going to tell us a lot on a go-forward basis relative to the markets. Now, the final sort of broader theme that I want to continue to bring back to the forefront as it relates to what markets are seeing right now. Obviously, the injection of liquidity and the safety net of the monetary policy and the Treasury, what they have done, has been tremendous, as we say, in high yields and all the other marketplaces in the fixed income arena. But specifically for the consumer, I keep bringing this up, which is the M2 money supply has exploded. Again, I reported this last week, the past 13 weeks. If you look at the M2 money supply, keep in mind it's a very simple sort of explanation of that would be sort of the deposits that are in all banks, for the consumer in small businesses. That exploded. It's up 82% over the past 13 weeks, and year over year up 23%. And essentially, what that's saying is that's adding up to about 12% of GDP, right? So we shut the economy down. We have all of that money out deployed into consumers' hands. And we want to continue to see high frequency data. This is a chart here of U.S. retail sales, and this is all these little lines here are showing all the regions across the United States, like Houston and San Antonio, Phoenix, Orlando, Cincinnati, and Naples, Florida. And what we're seeing are positive signs. People are going out and hitting the restaurants and a few other retail establishments. So we know they have money in hand. I think that's what the S&P 500 sees right now too, is that there's a lot of sort of fuel to continue to add to these corporations that are publicly traded, the largest corporations that are out there. They're the big get bigger. In this case, we're going to see that, and 2/3 of our U.S. economy are consumers, and so the consumers have money in hand. In fact, today it's just been reported, and we will continue to report and follow this again, that Congress is looking at another round of more checks in hand. So I'm not trying to be overly bullish here. In fact, I'm not even supporting this setup, if you will, of constantly robbing our future with setting up all this debt that we're burdened with. And we can have that conversation and debate in weeks and months and years to come, and I'm certain we will. But even in the short term, what markets are paying attention to, so therefore we have to report, and as we're watching and monitoring for our clients, these are all important information and things that we keep an eye on. So I just want to report that. Everyone stay healthy and safe, and God bless.